It is your fault that you're getting declined for a mortgage. Now, just understand, there's very simple, basic steps to do when you want to buy a home. But when you don't follow them, you're going to get that big fat D for denial. Nobody's happy, and you get declined for that mortgage. My name's Andrew Russell, owner and founder of RCG Mortgage. Three-time winner of NAMBY Broker of the Year, top originator across the country via Scotsman Guide, and just around the #1 mortgage guru that ever existed. Let me tell you a quick story. So you have a story of a man named Bruce. And heck, let's throw in there the story of a young lady named Beth. Bruce, he thought he was the man. He made all this money. He bought all this stuff. It's time for Bruce to buy a house. So what does Bruce do? Bruce is a know-it-all. He doesn't listen to anybody. So he charges up his credit cards because that's just what you do, right? Bottle service, kind of expensive. He gets another car because I guess one car wasn't good enough. He needed another one with a high payment. He did all this other stuff to get in the way of him buying a house. What happens to Bruce? He goes to the bank, he pounds his chest, asks for a pre-approval. Sorry, Bruce. Don't be Bruce, guys. Bruce gets denied for a pre-approval for a house. Now then, there's Beth. Beth watches Andrew Russell, watches these episodes. On this one, learns what she shouldn't do. Beth listens. Congratulations, Beth. You're a phenomenal listener. She doesn't do any of the stuff that people typically do to affect their purchase. Saves up to buy a home. Not all that much money, which we'll talk about. She's able to reach out to her loan officer, talk through a pre-approval, get pre-approved, and within 1 to 2 months, puts herself in a position that she now finds a house, gets an accepted offer, goes into contract, and closes a month later, and voila, Beth is having the Labor Day barbecue with Bubba Burgers, living the dream with her family, and Bruce is still living in his parents' basement. Now, I hear you now, folks, right? Buying a house, it's impossible. All anyone talks about is that it's so hard to do, buying a house. Wrong. It is not that hard to do. It just takes strategy, planning, consultation, and a process and a plan. You just have to follow it. I hear you as well. You know, it's so much money to put down. Unless you save 20%, you can't buy a house. That'll save me 20 years to do. Wrong. 20% is not the rage, or as the kids say, it's not the tea right now, folks. There's many ways to put down little amounts of money, and even with the rates are with where they are right now, it's still super affordable to buy a house. So I hear you right now screaming for it, begging for it. Andrew, what are the things that we should avoid so we can buy a house? And it can be an easy and expedient and efficient process with no bumps, no bruises, no scars, and we find ourselves a great property, get an accepted offer, go into contract, and close, all with an amazing process. We too, just like Beth, can have that Bubba Burger for Labor Day with our family. So there's actually 4 things in this market that are very typical to what I've seen of how people are just nuking themselves when they're buying a house. So the first thing is similar to Bruce, is your credit. So a couple things. Number one, the soft pull has become all the rage. What's all the rage mean? Well, I'm not going to tell you what it means, based on what the kids are saying, but all the rage for the credit side is a soft pull. We can actually run a tri-merge credit report for you. Now, remember, there are 3 bureaus, Experian, TransUnion, and Equifax. We take the middle of the 3 scores for mortgage purposes. Now, if you have the highest is 850, the lowest, which I've never seen, people have tried, is a 350, and your middle score, say, is a 650. We take that middle score of the 3, and that's what your effective credit score is. And the soft pull gives us the exact credit report we would use if we got a hard pull. Now, a hard pull is a mortgage credit report that we need to buy a house, but a soft pull will give us all that information, but it's not a hard inquiry, meaning it's not going to lower your score. No one will ever know we ran it. But of course, once you find a house, we convert it to a hard pull. But on that credit report, there's so many people that say, hey, I have Credit Expert, or I have Credit Karma, or 123 Credit, whatever's out there, I'm not even sure. And it says I have an 800 score. Well, unfortunately, that is not a mortgage credit report. So we've seen people all the time. They say, I don't understand, Andrew. I have a 780 score on Credit Karma, but you're telling me when I just went to get a pre-approved, I now have a 620 credit score. So it is very important. It's very important that step number 1, you have your credit run, do a soft pull so it doesn't affect your score, and go over it with your mortgage loan officer to see what type of stuff is on there, what type of debt is on there. People all the time when they're going to buy a house, somehow they feel incurring more debt makes sense. It does not. Think about it. The average house price has gone up, in our area. So your average mortgage payment, we used to be able to snap off a $2,500 a month payment all in with tax and insurance for a first-time buyer. I think that's like $5,000 now, maybe if you're lucky. So if you have increased debt now with the mortgage at $5,000, is it the right time to go out and buy an expensive car? Probably not. Is it the right time to go out and get a timeshare? I'm thinking no. So just be very cognizant of the amount of debt you take on when you're going to buy a house, and of course, of your credit score. The second piece, which happens all the time, is it's great if you have a good job and you're W-2 and you're thinking, hey, I want to go into business for myself, going from a W-2 employee for a firm to starting your own firm, maybe in the same field. Let's take, for instance, let's say an attorney, right? So if you're an attorney and you're working for a firm, we all love the show Suits, right? What's up, Harv? And you're getting $250,000 a year in W-2 salary. You're like, I think I got this. I think I'll start my own firm. And you go to start your own. Now, as much as you might make more money and, maybe if you're self-employed, your net's a little bit higher in your head at least, it's actually going to really affect you to buy a house, and the timing could not be any worse. If you're going to change from a W-2 employee to a self-employed individual, start your own business, wait till way after you've purchased your house. Now, as an example, if you're W-2 making $250,000 for the year and you start your own business, at least 1 year is going to have to elapse of a filed tax return, at least, for a lender to be able to utilize that income. So all it's going to do is delay the ability to purchase. So if you're thinking of changing your job, make sure you talk through with your mortgage professional first, but 99.99% of the time, you will not be able to, or you're just going to have to wait a year, if not 2 years, to buy a house. Now, the third thing that we're seeing all the time for mistakes or things buyers aren't prepared for is super pertinent and prevalent in this market. It's the gap of what you offer for a house for a sale price and what it comes in from an appraised value perspective. So right now, think about it, right? I don't know if you went to economics class, but remember supply and demand. So right now, supply, the amount of houses on the market, inventory, right, is very low. Demand is still high. People want to buy houses. So as that supply comes down, demand goes up. People are willing to pay for the asset, the house, more than it's worth. It just happened during COVID with cars. There were not that many cars and trucks available. So if something was worth $60,000, by the time it landed, people were going to pay $70,000 because you need cars. Same thing goes with houses. Now, if you have a house selling for $600,000 and you really want the house, you and your family, maybe it's just you see yourself there. You could see raising a family there. People are making offers. So instead of offering $600,000, you offer $700,000. So of course, on paper, you're willing to pay $700,000. Maybe you qualify for the mortgage. No big deal. But the bank, when you get an accepted offer at that $700,000 to go into contract, the bank, us, we're going to get an appraisal. And if the house is not worth $700,000, we're only going to lend a percentage off of what it appraises for. So take that $600,000 sale price where you now offered $700,000. What if it really only was worth $600,000? You might have to make up the gap of that $100,000. So it's a huge mistake people are doing going into buying a house. They don't realize if they buy something, offer over the ask price, what happens if it doesn't appraise for that? It's just not being talked about. I don't know why. Real estate agents, mortgage professionals, it's not coming up as much. And it's very, very important to know, A, you might have to make up that difference, or B, you might not have to make up that difference. We'll talk about why, but you might have the addition of like a PMI per month, or your payment might go up. So say, for instance, you're putting down 20%. So if you're putting down 20% off that $700,000 number, 80% of that is $560,000. But if the house appraises for $600,000 and you're trying to borrow $560,000, technically that $600,000 number, 5% of that is $30,000, which would be $570,000. So you're borrowing, follow me, $560,000, but $570,000 is 95% of that $600,000. So the bank will go off of that appraised value at $600,000. So originally you were at 80% financing. Now it's almost like you're at 95-ish% financing, which you might be eligible for. And if you are, you might be able to get away with not coming out of pocket anymore, but there'll be a private mortgage insurance charge allocated to your monthly payment. Now, PMI just means if you're getting a conventional mortgage, putting less than 20% down, someone somewhere thinks that you're higher risk, there's a forced place insurance put on you called private mortgage insurance. So that's a strategy where if the house underappraises, where that purchase may not get declined, but maybe that buyer's like, I don't want an extra $300 a month. maybe I can't afford it. I don't qualify. So it's a super important thing to talk through, but it's very, very pertinent right now. And people are just buying houses, paying over ask, and, you know, not really think about what might happen after the appraisal. Now, the last piece, the fourth thing that's super popular, mistakes made all the time, and why your boy is doing so well and has a job right now, is people are not shopping their interest rate. So people don't realize that right now there's 4 types of institutions that you can apply through to get a mortgage. The first is a retail bank like Chase, Wells Fargo, Citibank. The second is a credit union in our area, Teachers Federal Credit Union, Beth Federal, Jovia, you know, whatever credit union is the second type institution. The third is a mortgage bank, you know, national lenders across the country like Cross Country or Homebridge, lenders of that sort. And the fourth is you can apply through a mortgage broker company like RCG Mortgage, and they will shop your rate for you with all the banks. So people don't realize if they're looking to purchase and get all the different types of mortgages, right? And there's a ton of them. Conventional, Fannie Mae, Freddie Mac, primary, investment, second home, minimal down, more money down, right? Non-QM, which is all the rage right now, which is stated income, bank statement programs, 1099, no income check. There's all these different types of loan programs. And just because you go to a bank doesn't mean that one bank specializes in all those mortgage programs. That's what makes brokers so good and so unique. Now, maybe that person was going for a pre-approval, didn't shop around their program or their rate, didn't use a mortgage broker, and they think the rate or the payment is too high, or heck, that lender didn't even offer that program. Non-QM, as an example, if you're a self-employed borrower and you want to buy a house, you can get away with not using your tax returns, but using 12 months of your business bank statement, looking at the cash flow deposits, which is always higher than what you're claiming on your tax returns. Now, maybe that self-employed client, they wanted to buy a house, got declined for pre-approval, and they're just renting, not realizing if they could just save up 10 to 20%, they can buy and show a mortgage broker loan officer their bank statements who could align them with the right mortgage bank and get them a great program. So the biggest mistake that we see happen consistently is just because you want to buy a property, just because you want to buy a house, just because you want to buy an investment property, doesn't mean you just call the bank that all your cash and your checking account is with, right? It's super prudent to shop around the program, shop around the interest rate, and make sure you work with a mortgage broker company so you can get the best deal, but also the widest array of products. So you've listened to your boy, you've made none of the mistakes that we just went over, and you're putting yourself in a great position. Now it's time to buy, whether it's a move-up home or a downsize or an investment property or whatever the circumstances. Maybe it's a nice little apartment for one of your children. But unfortunately, us banks, we oftentimes can lend a lot to people, but that doesn't mean necessarily you can afford it. So make sure you watch our next video. We're going to talk about affordability so you don't bite off a bigger piece of house than you can chew.